Good day, fellow investors. Greg Meisner here, Chief Operating Officer of Veripath Global Investing. We decided we wanted to introduce you to more of our team throughout this series of videos, so you'll see some new faces as we go along. We hope you enjoyed the theme music, and it's a good theme to keep in mind, especially given the fourth quarter of last year. So let's look at a few returns and discuss some silver linings of a market decline. Concerns about political drama, the trade war, and tightening monetary policy all converged to push stock markets down across the world. U.S. stocks led the decline on the broad global markets in the fourth quarter. The only bright spot was that interest rates declined in the fourth quarter, providing a small price increase, boosting the returns. For the full year, all stock markets were down and bond returns were flat. As we've said in previous videos, we don't believe we're on the precipice of a recession. The markets seem to have come to the same conclusion. The markets have been bouncing back, with the sector which declined the most in the fourth quarter, energy infrastructure assets, leading that rally. The returns shown are through the end of January. This slide is one of several economic leading indicators we follow. There was a decline in this indicator, yet it is still at a very healthy level, showing that the economy is continuing to move forward at a healthy pace. One point to make for you that are invested in the global stock market is this chart shows what is called the cyclically adjusted PE ratio, or price to earnings ratio. It basically shows how many dollars you need to spend to get $1 of earnings for each of the three global stock market segments. You can see the U.S. stock market has become pretty expensive by comparison, yet emerging market stocks are trading fairly inexpensively. As a result, we raised the position of emerging market stocks in the portfolios with stock exposure and have remained more conservative in U.S. stock holdings. This chart shows two different ways of estimating the longer-term returns for the various asset classes. The average of the two methods is shown in the column titled Prospective. In the stock market, the better future returns are likely to occur in the least expensive markets. Both energy infrastructure and emerging market stocks have the highest prospective returns. Also, for those of you that are primarily or totally in the bond market, the returns going forward are about what you'd expect in the low interest rate environment we're in, but these are the assets that offer the best market downturn protection as shown by last year's return numbers. While declines do occur in the stock markets, because they do recover and provide higher returns over the long run, they are a good investment for those who want higher rates of return and are willing to ride out the volatility. Thanks for watching.
Don't worry, be happy.